Remember December 2024, stock markets are hitting record highs, tech stocks are soaring. Every company press release mentions AI, every earnings call promises AI-driven growth. Investors are pouring billions into anything with artificial intelligence in the pitch deck. NVIDIA's market cap has exploded past $3 trillion. Microsoft and Google are spending tens of billions on AI infrastructure. Startups with minimal revenue are raising hundreds of millions at billion-dollar valuations. The message is clear: AI is the future, and the future is now. But here's what nobody wanted to say in December 2024. This looks exactly like a bubble. Not might be a bubble, not could become a bubble, is a bubble. The warning signs are everywhere: irrational valuations, unsustainable growth projections, mass hysteria disguised as strategic vision. Companies with no AI expertise suddenly becoming AI first. Investors who can't explain the technology pouring money into it anyway. We've seen this before. The dot-com bubble of the late 1990s, the housing bubble of the mid-2000s, the crypto bubble of 2021. Each time the narrative was the same. This time is different. This is revolutionary. The old rules don't apply, and each time reality eventually arrived, violently. Now, as we move through 2025 and look toward 2026, the question isn't whether AI is real. It is. The question is whether the market valuations, the growth projections, and the hype match reality. And increasingly, the answer is no. Today, we're examining the unspoken December tech bubble. We're identifying the warning signs everyone ignored. We're analyzing what happens when hype meets reality. And we're re-asking the question that could cost or make you millions. Is AI's seemingly unstoppable rise actually on the brink of bursting? Welcome to the anatomy of a bubble. Let's see if we can spot the crash before it happens. Something fascinating happened in late 2024. Companies that had nothing to do with AI suddenly became AI companies. A cloud storage provider, now an AI-powered data intelligence platform, a customer service software company, transformed into an AI-driven customer experience solution. A basic analytics tool, reborn as cutting-edge AI insights technology. The playbook was simple: add AI to your marketing, mention machine learning in your earnings calls, announce an AI initiative, and watch your stock price jump 20, 30, sometimes 50%. This wasn't innovation. This was rebranding. And it worked spectacularly. Why? Because in December 2024, investors weren't asking hard questions. They were afraid of missing out. FOMO was the dominant market emotion. If you weren't invested in AI, you were leaving money on the table. Or so the narrative went. Traditional software companies saw their valuations stagnate while AI companies soared. The pressure was immense. Boards demanded AI strategies. Executives scrambled to rebrand existing products. Marketing departments went into overdrive. The result, a market flooded with AI companies that were doing exactly what they'd been doing before, just with different labels. This is classic bubble behavior. When the label matters more than the substance, when rebranding drives more value than actual innovation, you're in dangerous territory. Let's talk numbers, because the numbers in December 2024 were completely disconnected from reality. AI startups with single-digit millions in revenue were raising at billion-dollar valuations. That's 100x to 200x revenue multiples. For context, traditional software companies trade at 5x to 10x revenue. Even high-growth SaaS companies rarely exceed 20x. But AI companies, different rules apparently applied. One AI startup raised $300 million at a $2 billion valuation with less than $5 million in annual revenue. Their burn rate exceeded $50 million annually. They'd need to grow 100x just to justify their valuation and sustain that growth while somehow achieving profitability. The math didn't work, but nobody seemed to care. Public markets were just as frothy. Companies adding AI features saw their market caps increase by billions, not because revenue increased, not because profits materialized, simply because they announced AI initiatives. This is textbook bubble psychology. Valuation based on narrative rather than fundamentals, price determined by hope rather than results, investment driven by fear of missing out rather than rational analysis. Compare this to the dot-com bubble. In 1999, companies with .com in their name saw instant valuation boosts. Pets.com raised hundreds of millions and went public despite burning through cash with no path to profitability. The stock soared, then crashed. The company folded within a year. The parallels are striking. Replace doublequotes.com with AI. Replace internet revolution with AI revolution. The structure is identical, or considered a crypto bubble of 2021. Bitcoin hit $60,000. Every crypto project was going to revolutionize something. NFTs were the future of digital ownership. DeFi would replace traditional banking. The market cap of crypto exceeded $3 trillion. Then reality set in. Bitcoin crashed to 16,000. Most crypto projects failed. NFTs became virtually worthless. The bubble burst, wiping out over $2 trillion in value. AI in December 2024 felt exactly the same. Enormous valuations, revolutionary promises, weak fundamentals, mass delusion disguised as vision. But surely the massive infrastructure spending justified the valuations. Microsoft, Google, Amazon, and Meta were investing tens of billions in AI data centers, chips, and research. This spending was real. The commitment was genuine. These companies were betting big on it. But here's the problem. Infrastructure spending doesn't guarantee returns. In fact, it often signals bubble dynamics. During the dot-com bubble, telecoms spent hundreds of billions laying fiber optic cable. The infrastructure was necessary for the internet age. The spending was rational, but it vastly exceeded actual demand. Most of that fiber went unused for years. The companies that built it went bankrupt. The infrastructure was real. The bubble was real too. AI infrastructure in 2024 faced the same risk. Yes, AI models require massive compute. Yes, data centers are necessary. But was the scale of investment matched by actual demand? Or were companies building capacity for a future that might not materialize on their timeline? Nvidia's revenue was soaring because everyone was buying GPUs for AI training. But training is a one-time cost. Once models are trained, inference is much cheaper. The ongoing demand might not sustain the growth rates investors expected. Moreover, AI efficiency was improving rapidly. Models were becoming smaller, faster, and cheaper to run. What required a massive data center in 2023 might run on a laptop in 2026. Infrastructure spending could become stranded investment. This didn't mean AI wasn't important. It meant the infrastructure boom might outpace actual applications. And when that happens, you get overcapacity, falling prices, and collapsing margins. The warning signs were all there. The question was whether anyone wanted to see them. December 2024 saw a phenomenon that always signals bubble peaks. Generalist investors piling into specialized assets they do want to understand. Your uncle who'd never bought a tech stock was suddenly investing in AI ETFs. Pension funds were allocating to AI venture capital. Retail investors were day trading AI penny stocks. Financial advisors who couldn't explain a neural network were recommending AI exposure. This is the shoeshine boy giving stock tips moment that supposedly warned Joseph Kennedy of the 1929 crash. When everyone is investing in something, especially people who don't understand it, the bubble is mature. Why does this happen? Because late-stage bubbles are driven by FOMO, not fundamentals. Early investors made enormous returns. Those gains attracted attention. Media coverage intensified. Social proof took over. Nobody wanted to be the person who missed the AI revolution. So money flooded in. Not smart money carefully analyzing opportunities, just money, desperate to participate, terrified of missing out. The crypto bubble showed this perfectly. In late 2021, everyone was buying crypto. Your hairdresser, your grandmother, your dentist. Not because they understood blockchain technology, but because prices were going up and they wanted in. When the unsophisticated money arrives in force, smart money starts looking for exits. Not immediately, but they're watching, planning, waiting for the right moment to sell to the crowd. AI in December 2024 had reached that point. Generalist investors were pouring billions into AI funds and stocks without understanding the technology, the business models, or the competitive dynamics. They just knew AI equals growth equals returns. This is always how bubbles peak. Maximum optimism, maximum participation, maximum vulnerability. Every AI company pitch deck in late 2024 featured the same graph, a hockey stick. Revenue flat or growing slowly for a few years, then suddenly explosive growth. The inflection point was always now. The future was always up and to the right. These projections weren't based on customer pipelines or market analysis. They were based on faith. Faith that AI adoption would accelerate. Faith that their product would capture market share. Faith that competition wouldn't erode margins. But faith isn't a business model, and by mid-2025, reality was diverging sharply from projections. AI companies that had projected 10x revenue growth were achieving 2x. Some weren't growing at all. Customer acquisition costs were higher than expected. Sales cycles were longer. Enterprise adoption was slower. The hockey stick wasn't materializing. Why? Because projections assumed AI would be adopted as quickly as smartphones or social media. But AI is fundamentally different. Smartphones had obvious immediate consumer value. AI capabilities are often subtle, require integration, and compete with existing workflows. Businesses don't pivot overnight. They test, pilot, evaluate, and slowly scale. Enterprise sales take years, not months. Moreover, AI promised automation and efficiency, but implementing AI often requires extensive data preparation, infrastructure changes, and workflow redesign. The actual deployment is messy, expensive, and time-consuming. So the revolutionary impact that justified crazy valuations wasn't happening on schedule. Companies burned through cash waiting for customers. Investors started asking uncomfortable questions. The narrative began to crack. This is classic bubble dynamics. Projections based on best-case scenarios. Reality delivering slower, messier progress. The gap between expectation and results growing wider. Eventually that gap forces repricing, violently. By late 2024, AI-powered had become meaningless. Every product claimed to use AI, every company was AI first, every press release mentioned artificial intelligence. But dig beneath the marketing and you found very little actual AI. Simple automation rebranded as AI, basic algorithms called machine learning, standard software with AI slapped on the label. This wasn't just annoying, it was dangerous, because it created noise that drowned out genuine innovation, and it made investors skeptical of legitimate AI companies. The boy who cried wolf effect. When everything is AI, nothing is AI. When every company claims revolutionary technology, investors stop believing any of them. Consider customer service chatbots. Companies marketed them as advanced AI assistants, but most were just decision trees with natural language processing. They couldn't truly understand context, couldn't handle complex queries, couldn't learn from interactions in meaningful ways, or consider AI-powered analytics, often just dashboards with some predictive modeling. Useful, sure. Revolutionary, no. Worth a 50x valuation premium? Definitely not. The hype-to-substance ratio was completely out of balance and markets were starting to notice. Companies that overpromised and underdelivered saw their stocks punished. Customer dissatisfaction grew. Churn increased. The reality gap was becoming impossible to ignore. This matters because bubbles don't burst all at once. They crack. First, the weakest players fail. Then the mediocre ones struggle. Eventually, even strong companies get caught in the downdraft. The hype without substance was creating the first cracks. Let's be clear about something. Most of what was marketed as AI in late 2024 was not actually artificial intelligence in any meaningful sense. Real AI involves systems that can learn, adapt, and perform tasks without explicit programming. Machine learning that improves with data. Neural networks that recognize patterns. Models that generate novel outputs. What most companies offered was automation, rule-based systems, if-then logic, standard software repackaged with AI branding. There's nothing wrong with automation. It's valuable. It saves time and money. But it's not revolutionary. It's not worth 100x revenue multiples. It's incremental improvement, not paradigm shift. The problem was market confusion. Investors couldn't distinguish real AI from rebranded automation, so they valued everything the same. Companies with legitimate breakthroughs got lumped together with companies doing basic scripting. This created massive mispricing, and mispricing always corrects eventually. Consider AI in healthcare. Some companies were developing genuine breakthroughs, AI that could analyze medical images and detect cancer earlier than human radiologists. That's real AI. That's revolutionary. But other companies were just digitizing medical records and calling it AI-powered healthcare. Useful, yes. AI, barely revolutionary. No. Both types of companies raised at similar valuations. One had developed actual cutting-edge technology. The other had built a database with a search function. When the market corrects, that distinction matters enormously. Real innovation survives and thrives. Hype gets obliterated. Even companies with legitimate AI faced a critical problem: lack of sustainable competitive advantage. In tech, a moat is what protects your business from competition. Network effects, brand loyalty, switching costs, proprietary data, patents, something that prevents competitors from easily replicating your success. Many AI companies had no moat. Their models could be replicated, their data could be acquired, their techniques could be copied. There was nothing preventing well-funded competitors from entering the market and undercutting them. This is fatal at high valuations. If you're valued at $1 billion with $5 million in revenue, you better have an unassailable competitive position. Otherwise, competition will drive margins to zero and your valuation will collapse. Open source AI made this worse. Powerful models like Llama and Mistral were freely available. Any developer could fine-tune them for specific applications. Why pay premium prices for a proprietary solution when an open source alternative was nearly as good? Even the foundation model companies faced moat challenges. OpenAI led with GPT, but Google had Gemini. Anthropic had Claude. Meta had Lamar. Competition was intense and well-funded. No single player had an insurmountable advantage. In the long run, this means AI capabilities become commoditized, like cloud computing before it. Amazon Web Services was revolutionary and highly profitable initially. Now cloud services are competitive and margins are much thinner. AI would follow the same path. Initially expensive and proprietary, eventually cheap and commoditized. Companies valued on the assumption of sustained high margins would see those assumptions destroyed. Some AI companies understood this. They focused on specific verticals where they could build moats through specialized data or domain expertise. Healthcare AI companies with proprietary patient data. Financial AI companies with regulatory expertise. These had better chances of sustaining advantages. But most AI startups were building horizontal platforms with weak differentiation. Their moats were shallow. Their valuations were unjustified. Their future was precarious. AI companies in late 2024 were paying absurd salaries to attract talent. Fresh PhD graduates were getting $500,000 packages. Experienced ML engineers commanded over $1 million. Researchers with published papers could name their price. This created a talent bubble within the broader AI bubble. Why did companies pay these salaries? Because they needed to show progress. They needed to hire impressive teams to justify valuations. They needed big names to attract investors and customers. But here's the math problem. At these salary levels, companies needed enormous revenue to break even. A 100-person AI company with average compensation of $400,000 had a $40 million annual payroll, add overhead, and you're at 60 to 80 million in costs. You need over 100 million in revenue just to approach profitability at normal margins. Most AI startups weren't anywhere close. They were burning through venture capital, hoping to grow into their valuations before the money ran out. This is unsustainable. When funding tightens, and it always does after bubbles, companies can't maintain these salary levels. Layoffs follow. The talent disperses. Projects stall. The company's value proposition evaporates. We saw this in crypto. Companies hired aggressively in 2021 and early 2022. When the bubble burst, mass layoffs followed. Entire companies evaporated overnight. AI companies faced the same risk. They'd built organizations optimized for a bubble economy. When that economy contracted, their burn rates would become fatal. Bubbles don't burst randomly. They burst when conditions change. And by early 2026, several conditions were shifting against AI valuations. First, interest rates. The low-rate environment of 2020 to 2021 fueled speculative investments. Money was cheap, risk was rewarded. Long-term cash flows were heavily valued. But rates had risen significantly by 2024 and weren't coming down as quickly as markets hoped. Higher rates fundamentally change valuation math. Future earnings are discounted more heavily. Risk-free returns become more attractive. Speculative growth stocks lose appeal. AI companies, most of which had no current earnings and only promised future profitability, were especially vulnerable. Their entire value proposition was based on discounted future cash flows. Higher discount rates meant lower present values. If rates remained elevated or rose further, AI valuations would need to compress significantly. A company worth 10 billion at 2% rates might be worth 3 billion at 5% rates, even with identical business fundamentals. Markets were in denial about this in late 2024. They kept assuming rates would fall soon. But what if they didn't? What if inflation proved stickier than expected? What if central banks kept rates higher for longer? The repricing would be brutal. Bubbles burst when reality consistently misses expectations. And by 2025, AI companies were starting to disappoint. Growth rates came in below projections. Customer acquisition slowed. Profitability timelines extended. Costs exceeded estimates. The hockey sticks weren't materializing initially. Markets forgave these misses. It's still early. Adoption takes time. Long-term story intact. The usual excuses, but disappointments compound. 1 quarter of missed expectations is forgivable. 3 quarters becomes a pattern. 6 quarters becomes a broken story. By late 2025 and into 2026, the pattern was becoming undeniable. AI wasn't delivering growth fast enough to justify valuations. Companies started guiding lower. Analysts cut price targets. Investors began questioning the entire thesis. The tech giants provided some protection initially. Microsoft, Google, and Amazon had deep pockets and could sustain AI investments through slow adoption periods. Their core businesses subsidized AI experiments, but even they faced pressure. Investors started asking, when does AI investment translate to profit? How long do we wait? What if adoption is slower than expected? A major earnings miss from one of these giants could trigger a broader repricing. If Microsoft or Google reported that AI investments weren't generating expected returns, the entire sector would reassess. This is how bubbles cascade. One crack becomes a fracture. One disappointment triggers reevaluation. Suddenly everyone questions assumptions they'd previously accepted. By mid-2025, another dangerous dynamic emerged: AI fatigue. Consumers and businesses had been promised AI revolution for over 2 years. Where was it? Yes, ChatGPT was impressive. Yes, AI could generate images and write code. Yes, some business applications showed value. But where was the transformative impact? Where were the life-changing applications? Where was the promised productivity revolution? The gap between hype and delivered value created disillusionment. People started tuning out AI marketing. Businesses became more skeptical of AI pitches. The automatic credibility AI once commanded evaporated. This matters because bubbles require sustained enthusiasm. When enthusiasm fades, new money stops flowing in. Without new money, prices can't keep rising. And if prices aren't rising, existing investors start looking for exits. AI fatigue was real and spreading. The novelty had worn off. The promises felt hollow. The revolution seemed perpetually 5 years away. Compare this to the dot-com bubble. By 2000, people were tired of internet hype. Sites were slow. Most promised services hadn't materialized. The transformative impact was still years away, though it eventually came. The fatigue contributed to the crash, not because the internet wasn't important, but because the timeline for impact exceeded patience. Money flowed out before the real revolution occurred. AI faced the same risk. The technology was real. The long-term impact would be substantial. But if that impact took a decade to materialize, investors in 2024 would suffer massive losses in the interim. When the AI bubble bursts, and increasingly, it seems like when, not if, different segments will experience different outcomes. Foundation model companies with genuine breakthroughs and real competitive advantages might survive, though at much lower valuations. OpenAI, perhaps a few others. They have technology that works, customers willing to pay, and paths to profitability. Application layer companies with strong moats and proven business models could weather the storm. Vertical AI solutions in healthcare, finance, or legal with proprietary data and regulatory expertise have better survival odds. But the middle-tier companies with weak differentiation, high burn rates, no clear path to profitability, and valuations based purely on hype will be devastated. Funding will evaporate, customers will churn, teams will dissolve, valuations will collapse 80, 90, even 95%. The shakeout will be brutal. Most AI startups funded in 2023 to 2024 won't exist by 2027. Their technology might get acquired for pennies on the dollar. Their teams will scatter to survivors. Their investors will write off losses. This isn't pessimism, it's pattern recognition. This is what happens after every tech bubble. The internet bubble killed hundreds of companies. The survivors, Amazon, Google, eBay, became giants, but the casualties vastly outnumbered the survivors. AI will follow the same pattern. The technology is real and important, but 90% of current AI companies are overvalued, underdifferentiated, and unsustainable. They'll disappear. The few genuine innovators will emerge stronger. The question for investors is, can you identify the survivors before the crash? Smart investors aren't panicking. They're preparing help by focusing on fundamentals that bubble markets ignore. First, actual revenue growth, not projected growth. Is the company growing customers and revenue today? Not in some imagined future, but right now. If not, why not? If the technology is revolutionary, customers should be lining up. Second, path to profitability. Not will be profitable when we reach scale, but a clear, believable plan with realistic assumptions. How much does customer acquisition cost? What's the lifetime value? What are the unit economics? If these don't work at small scale, they won't magically work at large scale. Third, competitive moats. What prevents competitors from replicating this proprietary data? Network effects, brand patents, regulatory advantages. If the answer is our team is smart, that's not a moat. Smart people are everywhere. Fourth, capital efficiency. How much funding has the company raised relative to progress? Companies that achieve meaningful milestones with modest capital are better bets than those burning hundreds of millions with little to show. Fifth, customer retention. Are customers staying, expanding usage, telling others, or are they churning after initial trials? Retention reveals actual value better than any pitch deck. These metrics were ignored during the bubble because everything was going up. But when the correction comes, they'll determine survival. Companies with real revenue, clear profitability paths, strong moats, capital efficiency, and high retention will survive and thrive. Companies lacking these will disappear. The repricing will be harsh but clarifying. The pretenders will be exposed. The real innovators will stand out. Not every AI company will fail. Some will emerge from the correction stronger and more valuable than before. Which ones? Those solving real problems with defensible technology. Healthcare AI companies with FDA-approved products and clinical validation. They've crossed regulatory moats that competitors can't easily jump. Vertical AI solutions with deep domain expertise and proprietary data. They're not competing on general AI capabilities but on specialized knowledge. Infrastructure companies enabling AI deployment. Not the overhyped training infrastructure, but the practical tools for implementing AI in real businesses. AI companies that achieved profitability before the bubble burst. They're not dependent on continued funding. They can weather the storm and acquire distressed competitors. Enterprise AI companies with long-term contracts and sticky customers. They're generating recurring revenue from customers who've already integrated their solutions. These companies will see their valuations drop in any broader correction. Everything gets sold in a panic, but they'll recover quickly once rationality returns, and they'll acquire struggling competitors at fire sale prices. The post-bubble landscape always favors the fundamentally sound. Amazon and Google emerged from the dot-com crash as dominant players, not because they were spared losses, but because they had real businesses. The AI survivors will be companies that were building real value while others were chasing valuations. Here's the paradox. Even if the AI bubble bursts, AI itself remains transformative. The internet bubble burst in 2000 to 2002. But the internet didn't stop being important, it became more important. The companies that survived became some of the most valuable in the world. The difference was timeline and valuation. The late 90s valuations assumed internet adoption would happen in 2 years. It actually took 10. The technology delivered on its promise, just not on the timeline investors expected. AI will likely follow the same path. The technology is real. The potential applications are enormous. The impact will be transformative, but the transformation will take longer than current valuations assume. Adoption will be messier. Integration will be harder. The path will be less linear than projected. For long-term investors, this creates opportunity. Buy after the bubble bursts, not before. Acquire strong companies at depressed valuations. Hold through the recovery. For businesses, this means focus on practical applications with clear ROI. Don't chase AI for its own sake. Use it where it genuinely solves problems better than alternatives. For individuals, this means develop AI skills but remain adaptable. The specific tools and companies will change. The underlying skills of working with AI will remain valuable. The bubble bursting doesn't mean AI is over. It means the hype cycle is ending and the real work begins. We started with a simple question. Is AI's hype about to burst? The evidence suggests yes. Not because AI isn't real or important, but because valuations, expectations, and timelines have detached from reality. The warning signs are everywhere. Frothy valuations, disappointed projections, generalist stampedes, missing moats, unsustainable burn rates, growing fatigue, weakening fundamentals. History teaches us how this ends. The dot-com bubble, the housing bubble, the crypto bubble. Every time the pattern is the same. Technology is real. Hype exceeds reality. Bubble forms, bubble bursts. Survivors emerge stronger. AI is entering the burst phase. Not tomorrow, perhaps. Maybe not even this year. But the countdown has begun. The cracks are forming. The correction is coming. The question isn't whether it will happen. It's whether you're prepared. Are you invested in companies with real fundamentals? Or are you holding overvalued hype? Are you building AI capabilities with genuine ROI? Or are you chasing trends? Are you positioned to buy the survivors after the crash? Or will you be caught holding the bag? The December 2024 tech bubble will eventually be seen as obvious in hindsight. The valuations will look absurd. The projections will seem laughable. People will wonder how anyone believed it. But that's always how bubbles look in retrospect. In the moment, the narrative is compelling. The growth feels real. The revolution seems inevitable, until it isn't. The AI revolution is real. The timeline is uncertain. The current valuations are unsustainable. Prepare accordingly.